Has everyone found a seat? Maybe? The chair in the very back corner is missing a wheel. Okay. Alright, so as people are taking their seats, I just wanted to introduce myself and the speaker today. I'm Amy Perry. I'm president of GPNWomenN. Thank you for braving the fog, as well as whatever the weather is currently doing to come here today. Before I introduce today's speaker, we want to invite you to our upcoming event. We will be having International Women's Day the first week of March. It will be held at the Big Red Barn. Keep your eye out on your inbox for an email with more details. Now, I would like to thank the President's Council of Cornell Women Grant and the Graduate School for making this speaker series possible. Thank you all for coming to the first GPNWomenN PCCW speaker series of the year, titled Fundamentals of Investing, with Beth Prudence, certified financial planner and Cornell alumna who serves as the lead advisor of the Lenrock team at Morgan Stanley. Beth was raised west of Rochester, New York, and came to Ithaca to attend Cornell University in the fall of 1984, where she was an independent studies major in the College of Human Ecology. During her senior year, Beth spent a semester in New York City to experience working in the fashion and design industry. However, it didn't take long for Beth to begin craving the peace, space, and lifestyle she had become accustomed to in upstate New York. Moving back to Ithaca allowed her the environment to launch a career in personal finance and stay closely connected to her alma mater and take an active role in the community. She is passionate about organizing and analyzing finances, setting goals, and developing strategies for financial plans with the aim to help people make good decisions when it comes to their money. She currently resides in Lansing, New York with her husband Tony and has 2 children, AJ and Allie. Now it's time to up our financial IQ, so please join me in giving a warm welcome to Beth Prudence.
Thanks, Sammy. Appreciate that. I think I should take that year I graduated out of there. Makes me sound old. Okay, so I'd like to make talks as interactive as possible. So if you have a comment or a question as I go along, or if I say something you don't understand, because I sometimes get into that financial jargon, let me know. Just raise your hand and I can expand on anything. So what we're going to talk about is the fundamentals of investing. So how many of you were at my talk last time? Oh, just a couple. All right. So that was the psychology of investing, where we talked about how we felt, how we reacted, how emotion came into our decisions about money. This is more the nuts and bolts of investing. And some of this may be basic to some of you. I don't know if we have any finance majors or people that are in the financial world, but I'm going to do an overview for you and go over some basics. There are more rules and regulations involved in almost everything I'm going to talk about, so I'm happy to expand on anything. This is an ever-changing world, finances, okay? The whole financial world is. We have new regulations, new rules, new taxation. Over the 22, 23 years I've been in this business, the fundamentals have not changed. So if you can grasp some of these ideas, I think you can be successful as an investor. So let's talk about them. Okay. No, I'm not going to. Great. Now it's mine. Here we go. Okay. Gotta wake up. So this is what we're going to go over. Major asset classes, and how do you get to invest in those classes. The basic tenets of investing. What is asset allocation, diversification? Those are buzzwords we talk about all the time. Then I'm going to bring it all together and summarize for you, and we're also going to talk a little bit about individual retirement accounts or IRAs. Okay? Major asset classes. So, these are really busy slides. I'm going to go over some of this stuff. If you want me to expand, I'm happy to. But basically, there's 4 different asset classes when you're talking about the investment world. And they're going from no risk to high risk. We have cash. All right? Cash is the no risk investment. Banks, money markets, savings, CDs, Fixed income. Fixed income, a lot of people call these bonds, and we're going to go a little bit more in depth in each of one of these. Equities is synonymous with stocks, okay? And then we have a category that really doesn't fit in any of the top three, which is alternatives. These are your real assets, your precious metals, gold, silver, your real estate, your hedge funds, your long-short funds. So these are different strategies of investing in different areas that don't correlate with the other three. So let's talk about cash a little bit. Cash is important. You know, we talked in the psychology of investing that, you know, money isn't everything, but money helps. It buys you things, okay, which can help you. So cash comes in many different forms. You can have a checking account, you can have a savings account, which I'm sure all of you probably have. CDs, certificates of deposit. That's where you put money in a bank and you agree to leave it for a certain period of time, 6 months, 1 year, 2 years. The bank will give you an interest rate payment over that time, and then at the end, when it matures, at the end of the time period it matures, you're allowed to take your money back, okay? And what happens if you try to take it during that 6 month or 1 year period, if you agreed to leave it in, you pay a penalty, all right? Money markets. Money markets can be at a bank, financial institution, but money markets can also be an investment, a gathering of mutual funds present money markets, like T. Rowe Price, Vanguard, Fidelity money markets. I will caution people, money markets are usually a little better than investing in savings, but they're not quite as liquid. Unfortunately, during the terrorist attacks, okay, of 9/11, what happened is it shut the stock market down for a few days. And many people were using money markets as their main source of cash. Well, you couldn't sell anything. If the market's not open, you couldn't sell your money market. You couldn't get a hold of that cash. So I always comment to my clients that you should keep some cash on hand in a bank. As long as you can get in a bank in you know, banking hours, you can get cash at ATM, you can get cash. How many people even carry cash anymore? See? So, you know, maybe cash isn't king anymore, credit card is, but you want to be able to get a hold of the cash if you need the cash. All right, so if you're in the money market, you can't transfer that money into an account to be able to use your debit card if you use a debit card. And then T-bills fall into this. And these are no-risk investments. You put the money in, you're guaranteed up to a certain amount, it's insured, you can get your money out. Most banks will not give you more than $5,000 in any given day unless you call ahead, believe it or not. So if you want more, if you're going to take out more than $10,000 or use $10,000 worth of cash, probably you're going to do a report on you. Okay, so you know, cash is a way to certainly have things done and buy things, but most of us use credit cards or use checks or use other forms these days. But cash is still important. And cash can be your liquid investment. This is your emergency investment. This is if you plan that you're going to go on a big trip in 6 months, you're going to need a couple $1,000s in order to go on that trip. You should have that available, ready, liquid for you. Fixed income. So fixed income is a way to invest where you get a, what they call stable stream of money that could be paid to you or you can reinvest. This is investing in bonds, and there's different kinds of bonds that you can invest in. Basically what this is you are loaning money to somebody, to a corporation, a municipality, or to the government, all right? You give them money, and they give you a promise of an interest payment on that money. And then there's usually a maturity date in which they agree to give your money back. Now, where is the risk in that? Well, the risk in that is they don't pay the interest that they promised you, or you don't get your money back. Now, there are very low risk investments in bonds, government bonds, municipal bonds, those types of things. But if you get into corporate bonds or high risk corporate bonds, you're going to get a higher degree of interest or a higher degree of promise of payment, but you might not get your money back. Okay, so that's what's this continuum here is the investment grade, non-investment grade. So there are different levels of bonds that you can invest in. When I first started in the business 20 or so years ago, you could invest in a CD. Guess what the percentage rate of the CDs were back in the early 2000s? 6%. A CD, a one-year CD, 6%. You could get a money market that paid 4.5% to 5%. Can anybody tell me what a one-year CD pays now? Ooh, you'd be lucky to get 1.25. You might not even be able to get 1% on a one-year CD these days. So even though this says stable income stream, can you think of people who are investing in bonds for retirement and they want a stable income stream? The problem they're facing now is that they could get a 6% no-risk return 20 years ago, and now they're lucky to get 0.5% or 1% return. So it is a challenging environment. We are in a very low-risk environment. And so investing in bonds isn't what it used to be. It used to be something that you could count on a good income stream, and now we can't count on that great of a return. And the sentiment out there is that we're going to stay in this low interest rate environment. Equity. Equity is another word for stocks. And they say equity because you actually have equity in a company. If you buy a share of Coca-Cola, you actually own a piece of that corporation. You get to vote, and you have a share of the company. Now, how do you make money by buying shares of a company? Basically, there's two ways that you can make money. That company could pay dividends. Dividends can be in the form of cash or in the form of more stock, depending on how they want to pay the dividends. So by holding that share of stock, you could get some cash paid to you, or you could get stock paid, more stock given to you. Now, dividends aren't guaranteed. They're not a set number or set return. They can be taken away at any time. They can be lowered at any time. And some stocks don't even pay dividends, okay? The other way to make money when you invest in stocks is what's called capital appreciation. That means that you invested in a corporation and you bought a share of their stock, and their stock price went up. That's a good thing. You ever hear of the saying, buy low, sell high? That's what we're trying to do. We're trying to buy stock when they're low and sell when they're high, if you need the cash. So right now, the market is high or low? High? I think the market's high. Okay? So do you think now's a good time to invest in stocks? Maybe. Who knows? It's the highest that it could be. I mean, that's the problem of trying to predict. Okay, and we're going to talk about how you can kind of lower the risk when you try to predict. So we talked about dividends. So there's two usually main categories of investing in stocks. You can invest as a value investor, or you can invest as a growth investor. And I'll just give you a basic example. A basic example of a value company is a very established company that is predicted to give dividends, and they give dividends on a regular basis. And for some reason, their stock is trading low to their peers. And you're not exactly sure why, or maybe there was some kind of hiccup in their particular business, and they look like a value compared to other investments out there. So that would be value investing. You're investing for value. You just think that that particular stock is underpriced. Growth investing is more that you're investing in a company that you think is on a growth trajectory, all right? That it has not established itself yet, or it has something in the pipeline, or that particular area is growing. Can anybody maybe name an area or a company that might be in a growth investment trajectory? AI, artificial intelligence. So a company that is investing in AI, absolutely. That's a company that you think is going to take advantage of what's happening in the world, and it's going to be. Now, the key is, are you picking the right AI company or the right sector of that to be, the one to get the stock that's going to grow? But that's growth. Another good example that I like to use is a pharmaceutical company that has something in the pipeline that is going through testing and it looks like it's going to be a gangbuster drug, and you want to invest in that before it actually gets out to the market, because once it gets out to the market, that's going to be good for that company. So anything that's good for the company and makes the company money, hopefully will turn into share price, okay, and grow in share price. So that's stocks. Questions? Comments? Yes, please.
I'm curious, as a drug's patent reaches its end date, do people typically pull their money out around that time, or does it depend on the company, like Amgen, for instance?
Yep. You'll hear me say almost to every question, it depends. So if that's the only drug in their pipeline and that was a big part of their profit, then that's going to be a problem for them, obviously, because that's going to dilute the possibility of them continuing to make that kind of money on that drug. So that's something to consider. If they have other things in the pipeline, or that if they've done something, most companies hopefully have done something to take, replace that income that was coming off of that patent drug. So that's a good question. Yes?
What do you normally advise when you have clients come to you and say, I believe that this sector is growing, but it is highly dictated by the political environment? So there are a lot of companies that are investing in like cannabis and things of that nature, especially out on the West Coast, but you just don't know the political climate, whether that's just going to fall right through.
Sure. So, that really is speculative type investing, and that's a risk that you're going to have to take if you want to get into those areas. You're almost betting on something to at least go your way with the rules and regulations surrounding that particular sector. So what do I say to somebody is, let's look at what your basic investing is, and let's see what your ability is to withstand either a longer timeline than what you thought you would get on that particular stock, or that stock going down considerably. So, you have to make sure that your speculative investing is not your core investing, because if you pick wrong, then you're in trouble. So, yes?
In regards to dividends, where's the best place to look for companies that are, where would you see whether if they do give dividends or not? And then also for companies that are IPOing, is there anything that would signal if they would be paying dividends in the future?
I would say IPOs definitely don't pay dividends, obviously. They're in a growth mode. So, they have to be making money to pay money out. So, if they're in a growth mode, they're usually not making money. I mean, look at like an Uber who lost how many billions of dollars last quarter. So there's no money there to pay dividends. So I don't know if there's any way to tell if an IPO is going to be a dividend kind of paying company, but there's ways to tell. There's dividend history on almost any company that pays dividends. You can get right on Yahoo Finance, Fidelity's website, Vanguard's. I mean, there are up-teen numbers of websites that you can get on to see what is the dividend that's being paid. Now, what is it as a percentage of the stock price? Has it been consistent over time, or has it increased over time? And those are things that you want to look at as far as dividends are concerned. One more, and then we'll look.
What is the difference between a callable and a non-callable CD?
A callable?
Yeah, callable.
Callable, yep. So there's callable bonds, there's callable CDs. So callable means that there is a provision on that particular security that if you bought that security, and it says it has a 2-year maturity, so it's going to mature in 2022, but it's callable in 2021. That means they can call that bond. In other words, they can give you back your money. And there's usually call provisions on that. One of the call provisions depends on the company. They could call it par, which means what you bought it for, what they issued it, for. They could call at a premium. They could call at a discount. It's written into that. So a callable security means that if things are more favorable and that period of time that they call, it could be callable anytime they want, too. So you have to look at those provisions. Are you willing to invest money that you expect you're not going to get back till 2022, and you've got this great interest rate, but if they call it in 2021 because interest rates went down significantly, now you've got a reinvest problem here because you're not going to be able to get that kind of interest. So callable means they can call it and give you back your money before the actual maturity. Good question. So alternatives. This is much more popular than it was when I first started out. We really weren't talking about these particular categories, but alternatives are, again, non-correlated, and what I mean by that is, in a particular economic environment, these particular assets should not move in the same way that the stocks and the bonds move. They should move not necessarily in opposite directions, but they're not going to be correlated very closely to that. And so again, these are real assets, hedge funds, private investments, things that are not traded on the open market, long short funds, things like that. So these are different kinds of investments that you can add to a portfolio that will help you diversify, help you get other things. You know, this is the old thing that says don't put all your eggs in one basket. Now, I will say, I have a client, he wasn't my client originally. He invested in Apple with $24,000 years ago when Apple first came out. He now has $2.4 million in Apple. And I bet all along the way he was saying you should diversify, diversify, diversify. So, you know, diversification isn't everything. He just happened to pick the right stock and stick with it over the long term. And that was a good thing, and you know, maybe you don't need that, but that is not the norm. That is you know, something that doesn't happen very often. Okay? I will say that diversification and investing over the long run works. It may not be the best solution for everybody. So, you know, how do you decide what's right for you? Is there anybody over 30 in the room? Okay, so, you know, over 35? All right, good. So, you're young, way younger than I am. And, you know, now is the time that you have time on your side, and we're going to talk a little bit about how important time is. But, you know, is diversification important to you? Maybe not. Maybe you just need to get stuff in the stock market over the long term, and we'll show you this. Stock market has outperformed anything else. In fact, small company stocks have outperformed. Who cares if it goes up 50% and down 50% as long as that long-term trend is up? When we're talking diversification and non-correlated assets and, you know, spreading out your risk, that's going to be more important as you get older and as you accumulate more money. Okay? So I'm talking about these fundamentals and these principles, but they may not apply to you right now. What applies to you right now, we're going to go over in just a little bit, which is time, which is doing something. You need to do something. You need to save. Many of you are probably not even thinking about what retirement is going to look like. You're thinking about, how am I going to get my job? What is going to be my career? What is my life going to look like, okay? But if you can take just a little bit of money and think about the long term, you will be way ahead of everybody else. In fact, I always tell people this. If I had known then what I know now, I probably wouldn't be standing here talking to you. I'd be on a mansion on the beach, all right? So, you know, you have the power of time ahead of you, and it's hard to think about that now, but it's just a little bit that it takes over the long term that you'll be way far ahead, and you don't have to take a lot of risk to do that. But this is, you know, this is basically what you're looking at. Cash is for preservation. Everybody needs to have some cash or some cash available. You shouldn't live on credit card. You know, that's not good, and that's a whole nother seminar. But you should pay off your credit cards every month if you can. Have cash on hand to pay for what you need now and what you might need in the near future. When I talk to my clients, I tell them, let's look out 3 years. Are you going on a vacation? Do you need a new automobile? Do you have repairs to the house? Do you have anything that's above and beyond your normal income that you're going to have to pay for? You should really keep that in cash. It could be in a CD, it could be in a money market, but that should be in cash because that's money you're going to need now and soon. you know, one little flip of the market, if they're invested, could cause that cash to go down right when they need it, and that's not a good thing. Fixed income is for, again, that steady stream of income. Equity and stocks is for growth. And alternatives is, again, for mostly capital appreciation. There are some income components to alternatives, but again, it's for diversification. So how do you invest in these things? I can commit $100 a month. How am I going to invest in, you know, 5 or 6 different stocks? You're not going to be able to afford even probably half the stocks that are out there because they're over $100 a share. Okay? So how do you invest in these things? These are usually the 2 main vehicles people start investing in. One is mutual funds, the other is ETFs. They're actually both funds. ETFs is just exchange traded funds. And again, I am going to be very basic about this, but mutual funds were first brought about for managing people's money. So you could take that $100, buy a share of a mutual fund, and you could be invested in over 100 stocks. So what a mutual fund is a pool of money that investors invest in, you, me, other people invest in, and then they go out and invest that money for you, either in stocks, bonds, alternatives, or any combination thereof. So you can take that $100, invest in a mutual fund, and now you're invested in over 100 different securities by doing that. You can't take that $100 and invest in 100 securities, but you can invest in a mutual fund. ETFs were first brought about as a counterpart to mutual funds. Mutual funds were mostly managed. ETFs were mostly what are called passive or unmanaged. They're tied to an index. Who's heard of the S&P 500 and the NASDAQ 1000? Okay, so those are indexes. Those are a set group of stocks or securities that don't usually change too much. Nobody's there managing, buying and selling, dropping one, buying the other. It is a set group of stocks, and you can invest in those through mutual funds or ETFs, but ETFs are usually more popular to do the passive or the index investing. Okay, so some people say, why not just invest in the S&P 500 and let it ride? Probably not a bad thing. If you're going to let it sit there for 20, 30 years, you'll probably be perfectly fine. Okay? In volatile times or, you know, crazy times, sometimes a good manager can outperform the market or the sector that they're performing in because they have the ability to move. When you're investing in the S&P 500, you're investing in the good stocks in that group and the bad stocks in that group. So if you do have a manager who can take out the bad stocks and do a good job, then you might be able to outperform. So let's go over the basic tenets of investing. And this is one of the biggest ones. Again, time is money. You have time. I don't have as much time as you do to invest. And that's just the reality of the situation. And you can't buy more time. Okay, you can buy more securities, you can invest more money, but you are never going to get time back. All right, and time is your friend and on your side when it comes to investing. And I'll just point this out. And I know there's males and females in the room, and I'm not being biased, but I'm going to put a little slant to this here. So Eric, this is Eric. He's the first line. He invested $3,000 per year, starting at age 30, ending at age 70. A total of $123,000. And he invested in something that got 8% return. We're not talking about market timing or anything here. It's just an assumed 8% annual return. He's got $842,000 at age 70. Alex waited. He didn't get his job till a little bit later. He invested starting at age 40. So he waited 10 years, but he put more in. He put $4,000 more per year, $4,000 per year in. He started at age 40, ended at the same time. Just $1,000 more total invested, but look where Alex is. That's a lot of money. Less money. Okay, Jessica. Okay, so Jessica did not make as much as the boys. She had to take time off to raise the family and then got back into the business. And she didn't start until she was age 50. But she invested $6,000 a year. Okay, a little bit more per year. Same amount of money, but in a shorter period of time. Look how much Jessica accumulated. Same percent return for all three. So time is your friend. You know, at age 30, I'm hoping most of you can invest at least $3,000, but I'm going to tell you $842,000 isn't enough for retirement for you. I will use my son as an example. We'll get to the Roth IRA, and I'm going to use my son as an example. But think of this, so 842, look at the difference in accumulated money just because Eric started sooner. He had time on his side, compound investing. So you're making money, and then you're making money on the money that you make, okay? It's like a snowball going down the hill. We haven't had much snow here, but snowball going down the hill. It accumulates fast once it gets rolling and you're starting to make money on top of the money that you've made. This is from my last presentation. Don't let emotions. You know, if you invested and the next day your investment's down 50%, what's the worst thing you could possibly do?
Take it out.
Pull it out. Yeah, I mean when, 2008 happened, when 9/11 happened, people panicked and they pulled their money out. What do? Exactly the opposite of what they're supposed to do. You're supposed to buy low, sell high, and they are selling low. All right? If anything, when that happens, if you have more money, put more money into the market. I'm telling most of my clients we're being a little cautious for people who need cash right now, but if you have money on the sidelines, put it in. We don't know when this downturn, a lot of people thought this downturn was going to happen maybe 3 or 4 years ago. If you were waiting for the downturn to happen, you just missed out on some of the best years in the market. So you just don't know. And for you guys, who cares if the market goes down next year? You're not going to touch your money. You don't need your money next year. If you've got 30 years to let your money grow, it'll come back. And if it doesn't, we're all in trouble. Market timing is flawed. I like this slide because this really tells, somebody tells me, okay, I'm going to take my money out at the top, and then I'm going to try to put my money at the bottom and, invest that way and time the market. Okay, so this is from 1990 to 2019, and you can see the average annual return in the market that time was 9.7%. All right, I missed only 15 of the best days during that, 30-year period? 15 of the best days I missed. Now, look at what your return is. Average annual return is now 6%. Okay, so that's a difference of almost 4% over 30 years. That's 120% difference over the time period that we're talking about. If I miss 75 of the best days, so I waited, I think it's going to go down farther, but it went up and then down and up and down. 75 of the best days out of a 30-year period, I now have a negative return. So unless you time it perfectly or close to perfect, you're not going to do any better than just staying put and staying in the market. Okay? So trying to time that, if we could time it, we'd all be rich. But we're not. Again, this is an illustration that just says over the long term, who knows? Anything can change. But this has been our experience with the stock market over the long term. We've had a lot of hiccups, a lot of crises that come our way, a lot of, 1%, 2% moves in the market, but over the long term, stocks are the way to invest. Successful investing involves patience. We already talked about that. This is kind of interesting. So I feel that basically what I am is someone just to take the emotion out of the investing. I don't know much more than what my clients know, or much more than what my clients could possibly find out on the internet these days. I'm not an expert, but I am someone who can take the emotion out of investing for my clients and keep them on track, on a plan, on a strategy. This is the average investor return from 1996 to 2017. And why is that? Because they got online, they moved from this fund to this fund. Or, small caps are going really well, I'm going to take my bonds that aren't doing well and move them over here. The average annual return for different sectors, just stocks alone, was 7.2% during this time. If the average investor just stayed invested in stocks, they'd be fine. But they're moving their money around and changing things too often. Now, we change things for our clients and we manage their money, but we have a disciplined approach to it and we have a strategy to it. And we don't veer from that strategy, okay? Yes, go ahead, please.
So you just said stocks are the extreme, but gold has a higher.
Yep, and during this period of time, this is 1996 to 2017. Yep.
Why didn't you recommend gold instead of stocks?
So, that's a good question.
Just curious.
No, that's a good question. So, who knows what's going to be the next, investment that is going to show on this chart to be the best? And one reason why I wouldn't recommend gold right now is because gold has the best return over this period of time. Okay? And why do you say that? Because, and I'm going to show you another chart that's going to show that, but not necessarily is the best thing that has been in the past going to be the best thing in the future. You probably have seen past performance is no predictor of future results. Okay, so gold, yeah, it's a phenomenon. Now, if we look over the long term, if I go back farther, gold's not the most return. Okay, that we just picked a period of time that shows gold. Okay, but gold is very volatile. And many people think, oh, I'm going to invest in gold because it's the backing of currency and things like that. But what happens when you want to? You got to cash that gold in to get cash. So you have to find buyers. It's not quite as liquid. So, but good question. And again, it's chasing returns. So let's talk a little bit about asset allocation. What does asset allocation mean? That just means to invest in lots of different things and don't put your eggs all in one basket. And this is why. Your return is 91% based on the mixture of different asset classes that you have. It's not the individual security selection, it's not the market timing, we've already proved that. It is the mixture of the sectors and the asset classes that you have, okay? And so that's going to be the most important, and I'm going to rush through some of this. But what kind of asset allocation should I have? Who knows? It depends on your particular situation. Everyone is different. But when you're looking at low risk to high risk, you're going to have more and more of those more volatile assets, more growth-oriented assets, the more time you have and the more aggressive you want to be. I want to show you this, and this will point to your particular. So that time period, I didn't know if gold would be the way to pick, but this is an interesting thing. And you can't read this, so I'm just going to point out, you can hopefully see the colors. So up here, that's emerging market stocks, all right? Best, second best, look what it did the next year. Worst. So best, almost worst. Best, worst. You can't predict based on if I decided, oh, I'm investing in 2009, I look back, emerging market equities was the best, I'm going to invest in that. You would be fine the next year, but then you would probably lose about half your money the following year. So now that volatility might not matter to you over the long run, but this is a diversified portfolio, which is in the tan. So it's not going to do the best in the high times, but it's not going to do the lowest in the low times. And it's going to temper down your risk or give you good overall returns right in the middle of the pack. Different asset classes, different purposes in your portfolio. Time is money, time is your friend, time is important, and I know some of you guys have a class, so sorry. Successful investing requires patience, fortitude, a strategy, and diversification can provide better risk. I can stop now and answer questions. I do have some information on IRAs if you guys want to go forward with IRAs. So let's answer questions. Go ahead.
First, so you mentioned the difference between mutual funds and ETF. So I think there's usually a fee associated with the mutual funds.
There are fees associated with anything.
And the ETF.
Yes.
Are they different?
They can be, yes. So again, overall, an ETF that follows an index usually has lower fees than a managed mutual fund. Now, that doesn't necessarily mean I'm going to just invest in the security that gives me the lower fee, because fees aren't everything. Performance is important too. So if I have something that gives me much better performance over the long run with a higher fee, I'd invest with that. But fees are important over the long run. So yes, ETFs were brought about because most ETFs have lower fees than managed mutual funds.
Because I think sometimes one product can have both ways to buy them. One is through the mutual funds you buy the same product, and the other way is ETFs. Are they usually different, or it's just
They can be different, they can be similar. So you can buy a mutual fund that mirrors the S&P 500, and you can buy an ETF that mirrors the S&P 500. Well, they have similar type, it depends on which company you go through. Yes. But managed mutual funds have a tendency to have higher internal fees than index-oriented ETFs or any index-oriented investment. Let me just talk about our IRAs real quick, because you have the ability, if you have earned income, to invest in an IRA, and this is the first investment that you should consider. I'm going to use my son, who was 15 last year, and he worked for the first time. He made $1,100 last year. And now he spent $1,100, but he made $1,100. But I am putting $1,100 into an IRA for him, okay? So if you have earned income, and I know some of you are on grants or research money, so you have to find out from a tax provider if it qualifies as earned income. But earned income is usually a W-2 or a 1099 or taxed income of some sort. Then you can invest in an IRA. An IRA is an individual retirement account. There are maximums. The max is $6,000 a year, unless you're over 50 like me, and then you can invest more. But there are two main kinds of IRAs. Traditional IRAs and Roth IRAs. I will say the Roth IRA is the one thing that came out of Congress that was a good thing. And I would take advantage of it while they still allow it to happen. So basic premise is traditional IRA, you get a tax deduction for your contribution today. It grows without you paying taxes on it, and when you take it out at retirement, it will be taxed at your ordinary income tax bracket then. Who knows what tax brackets are going to be when you retire? So this is a guessing game a little bit, all right? So a Roth IRA, is you put money into an IRA, you don't get a tax break now, but it grows without you paying taxes on it, and then it's tax-free, the principal and growth, when you take it out at retirement. And retirement means it's been there 5 years and you're over 59 and a half, at least as the rules are now. If you have the ability to do a Roth IRA, do it. You can put 100% of your income away up to the maximum. That maximum is indexed for inflation every single year, so it goes up a little bit. For those of you who are over 50, you can do more. Catch-up contribution, because they know we have to catch up to everybody. But that's the one thing. Now, that doesn't have to come from your pocket. You can ask mom and dad, hey, mom and dad, I made $3,000 last year. Can you put $3,000 in a Roth IRA for me? So it's your IRA, but that money can come from any source that you want it to come from. So if you leave here with nothing else, it's that. Do a Roth IRA. Tax-free growth. When has the government ever given us tax-free anything? So this is a great thing if you can do it. Yes, they could take it away later on, but I doubt that they would take it away from any of you guys that have already done one.
And would you then recommend a conversion to Roth IRA from the traditional to have that?
Oh, wow, you're coming up with something. So, it depends. Those people who have traditional IRAs, okay, whether it be pre-tax or after-tax, can convert to a Roth IRA. It is a taxable event. But if you're in a very low tax bracket and you have a very long time to let that money grow, may be a great idea to convert to a Roth IRA. Now, some people have to be careful, because you can't just pick this IRA over here. If you have 5 IRAs and you just want to do this one because it hasn't grown much and it won't be much of a tax burden, you can't do that. You have to consider all your IRAs that you have when you do a conversion as to what the taxation of that conversion will be. But yes, that's a great idea. And those people who may not qualify for a Roth because you make too much money, which I'm not so sure you guys make too much money yet. I think it's $195,000 a year for single filers, maybe. You can't do a Roth IRA, okay? But you can do a non-deductible traditional IRA and convert right now. We call that the backdoor Roth IRA. They may take that away at some point. And the other thing I would encourage you to do when you do get a job and you do have a retirement plan at work, consider investing into that as well. At least up into the match, because that's free money. Yes?
So what happens if now we can invest if we put the money to the Roth and then later on we go beyond that bracket?
The money that you have there continues to grow. And remember, what was it, Eric? You started early, you've got time on your side. That money can stay in the Roth. You just can't contribute new money to it. But it can stay there, you can invest it and let it grow. Yeah?
If we invest in the Roth, let's say now, and we don't want to look at it until do we need to check in every now and then?
Yeah, you should. So, you know, if you're just investing in an index fund or something like that, you don't have to check it too often, but once a year I would look at it. If you invest in a single stock, then I would look at it more often. You know, things happen with companies, they could go out of, I mean, Enron went out of business, so yeah, you should look at it. If you're investing for long term, you should look at it about once a year. But for our clients, we're looking and reviewing quarterly. But you guys just need to look once a year.
For an IRA, things of that nature, where we start off fairly aggressive, then kind of shift towards more conservative. And what kind of is that age period when we should consider going more conservative?
What's my answer?
It depends.
Yeah. So I mean, I've got clients, younger clients who are, their goal is to retire at 55 and they want to create income at 55. So we may invest differently for them, and we need to start looking at something different, you know, by 45. I would say at least 10 years out from when you're ready to start having that money, you know, be a source of income for you. So usually about 10 years out is what I say is when you need to start looking at it more closely and what your risk return profile is compared to what you're going to want to do. Any other questions? Yes?
Is U.S. citizenship or tax residency a requirement for an IRA?
No. Earned income is, you need to fill a W-8 out. So there are some tax forms that you have to fill out. But no, if you have U.S. earned income, you do not have to be a U.S. citizen to invest in that. Now, what happens with it when you leave is another story. Yes?
I have a Roth IRA, and every year I put in my money, and I sit down with my dad, and he helps me do it. But I was wondering if there's a practice or trend. I never know if I should put in my money to the same mutual funds that I already have, or add new ones.
Okay. So, until you get to about 100, 150,000, you don't have to diversify amongst lots of different mutual funds. You know, they say 4 or 5 mutual funds is probably good. But you're in a situation where you really don't have to diversify much. You could pick one nice, really aggressive small cap stock fund and just let it ride for now. So, you know, you don't have to. And they say I think it's over 12 different kinds of investments or mutual funds, then there's no benefit to doing any more from that. So, you know, I'd say stick with the same fund. If you have an advisor, then there is a benefit from sticking to the same fund company because you're going to accumulate credits to be able to get a lower commission. If you're investing on your own, it doesn't matter as far as the commission goes. But I would say a couple of mutual funds is fine, and you can invest in the same ones as long as they're still doing what they're supposed to be doing. Yeah. Anything else? I'm fine staying after. Yes, one more. What's that? Sure, what do you want me to say about 401k? So 401k, 403b, 457, those are all segments of the IRS code that basically describe a retirement plan that's sponsored by an employer, okay? And if you have the ability to invest in one, I'd say start as soon as you can. It's easy. It's directly off your paycheck, which you don't think about. And remember, if you're going to be paying taxes, $10 into the 401k is $10 for you into the 401k. If you took it in your paycheck, you would pay taxes on it. It'd be more like $7 in your pocket. So anything you can do, you know, into that, I think is worthwhile to do. Now, 401k 401k versus Roth IRA, you know, I need some money to live too, I can't put all my money away. I would say do the 401k up to the match. So if you get a match, usually companies do a match. Let's say you get a match on 5%. I would do 5%, get the 5% match,